Welcome to Yahoo Finance Live. I'm Julie Hyman. That is Josh Lipton. We're here at the New York Stock Exchange to bring you the top stories you should be watching at 3 p.m. Eastern. The Consumer Price Index coming in a little higher than the street expected. CPI rising 3.7% year over year in September and 0.4% from August. Core inflation, which excludes food and energy, coming in line with expectations.
And no relief for home buyers. Mortgage rates continue to climb for a fifth consecutive week. Housing market struggling under the weight of elevated rates and prices and low inventory.
And finally, the Social Security Administration announcing the cost of living adjustment for 2024. Retirees can expect a much smaller raise in their benefit checks next year. This coming as Americans continue to see inflation well above the Federal Reserve's 2% target. Let's get you up to speed right now on the market action. We have seen stocks take a turn lower here as the day has gone on. The Nasdaq right now down 0.8%. The S&P up about 0.7. The Dow off about 0.6%. That's a drop of 200 points. And once again today, some of the action being driven by what's going on in the bond market. So let's take a check on treasuries here. There was an auction at 1 p.m. Of 30-year notes that came in with a little bit of weaker demand than expected. That seemed to be a bit of a turning point for the market. That's when we started to see yields really take off here and stocks take a leg lower. We're going to get much more on that with our Jared Blickery in a bit. But you see right now, back up to 4.71% on the 10-year and once again towards 5% on the 30.
Yeah, so let's start with what is moving this market here. Let's start with the economic data. The inflation data today, that September Consumer Price Index. Headline CPI was a bit warmer than expected, so rose 0.4%, and that was after that 0.6% increase in August. Core, as you mentioned, Julie, so Xing out those volatile food and energy costs, those categories, that was in line, so that came in as expected, 0.3%. And then digging a bit more under the hood, economists know that prices at grocery stores basically were unchanged, those shelter costs accelerating in September.
Yeah, shelter costs, and that's one of the things that the Fed has been watching closely, although there's a lot of sort of criticism of how shelter costs are calculated and whether that should be something that gets some focus. There's also focus on the so-called supercore, which excludes those shelter costs. So all of this coming into focus. But the bottom line here is that this was not a clarifying number.
No, it was kind of muddy.
Many investors. Bank of America, economists led by Stephen Janot, writing in a note today, a reminder there is still more wood to chop for the Federal Reserve when it comes to inflation. Basically, they say maybe the Fed will pause next time, but they think it is possible that the Fed will not pause. And then Krishna Guha, who's the vice chair over at Evercore ISI, who watches the Fed very closely, calls the CPI report not a good one for the Fed and will keep the U.S. Central Bank in wait-and-see mode.
Yeah, listen, I think obviously Jay Powell and policymakers are focusing on that core. So the continuing question is, are they seeing enough, at least moving in the right direction, that they feel like we're good with pausing right now? They wouldn't be waving the victory sign, but at least do we have enough good momentum in the direction we want that we're willing to sit tight for now?
Right. We'll see. And we'll get another opinion on that right now. Let's talk more about that CPI data coming in a bit hotter than economists had anticipated. The latest data rising for the second straight month. The headline number, a gain of 0.4% in September, 3.7% from a year ago, higher than the street expected. And the core, which excludes food and energy, is up by 0.3%. In line with expectations. Now, many analysts are pointing to shelter costs being the main driver, accounting for around half the rise in CPI. And by the way, those were shelter away from home costs, a lot of them, hotels. Joining us now, Michael Darda, Roth MKM chief economist and macro strategist as well. Mike, it's great to see you. Man, that's a lot of numbers I threw at people. Give me the bottom line here. Is inflation moderating enough for the Fed to take a pause or be done after its next meeting?
Thanks for having me on, Julie. I think inflation has come off the boil enough for the Fed to stay on pause here and assess the macro conditions. Keep in mind that inflation's a lagging indicator. Inflation will tend to lag the business cycle. So if we just have the Fed jamming the policy rates higher and higher and higher until inflation goes all the way back down to their target, we'll be in a very, very deep and protracted recession. And the Fed knows that. And so they're trying to gauge the state of the economy. But this set of numbers does not help. You mentioned the super core inflation numbers. So I'm afraid Jay Powell has kind of painted himself into a box a bit. by focusing on that specific set of numbers, which was not good this morning, up 6 tenths, and that follows a 4 tenths rise in August. Now, the good news is the 3 or 4 months before that looked really good. So I think we should have some patience with these numbers because they can be volatile and they do lag the business cycle. But definitely the higher than expected inflation data on the core side is going to reinforce this idea of higher for longer. And that's the main reason that bond yields were shooting up over the course of the last 4 or 5 months.
Mike, it is great to see you and your very handsome dog there in the background, Klaus, just chilling. We're very pro dog here on Yahoo Finance, Mike, so it's great to see the two of you. I just wanted to know, Mike, one question I had for you as an economist was, can the Fed get that inflation back down to their 2% target when the labor market, Mike, remains this sturdy?
Yeah, great question. So many of the Fed members are pretty worried about the tight labor market. They sort of are still operating with this Phillips curve framework in their head. And so, they're kind of on edge in terms of whether they should continue to tighten more or to be patient. But what I would say is the labor market's very, very tight, but the unemployment rate has been going sideways now for over a year. In fact, there's a subtle rise going on. Year over year, the unemployment rate is up actually 3 tenths. And it doesn't sound like a lot, but keep in mind that when you go up 5 tenths from year earlier periods, that's always marked the beginning of a recession in post-war history. So, the labor market is tight, but the flat to slightly higher unemployment rate would suggest the economy really is just kind of meandering at trend. People are really excited about Q3 and the Atlanta Fed number as this huge, almost 5% GDP figure, but I don't think it's likely to be sustained if we do see it at all.
So, Mike, that's your economist hat. Let's get you to put on the strategist hat as well, because in some of your recent notes, you talk about the risk premium in the market. Now, everybody's been talking about the risk premium in bonds lately, but you're also talking about the equity risk premium here. And what you seem to be saying, if I'm reading you correctly, is that the market is not priced right now in terms of some of the risks that you're talking about from an economic perspective.
Yeah, that's exactly right. So we've had this big surge in bond yields this year and, a fairly minimal pullback in equity prices. And so the result is if we look at the earnings yield on stocks, which is just the inverse of the PE, relative to the 10-year Treasury yield, equities actually have not become cheaper relative to bonds. They've become more expensive because bond yields have gone up so much relative to an equity market that's not much off of the highs of the year. And if you go back, we're talking about, real rates and inflation expectations. Real rates on the 10-year Treasury are up above 2%. And if you have to really go back to the 06 to 2006 to 2007 period to see a sustained period where real rates were above 2%. The forward PE on the S&P 500 during that period was actually around 15, and we're at 18 now. And so I think we have a problem with the equity market valuations if the 10-year yield stays in current ranges or pushes higher. If it pulls back, it was earlier this week until this inflation report, I think that helps, but it doesn't really help if the equity market's rallying at the same time. So you really need the bond market to outperform the equity market for stocks to become cheaper relative to bonds. And I think ultimately that's what's going to happen as we move through the end of the cycle.
And Mike, just given that outlook then, as you look at the equity market here, are there sectors that you're telling clients you find more attractive?
Yeah, absolutely. So we'd be a little bit wary on what has led the market this year. So the Infotech Index has been a star performer, incredible. Obviously, there's a lot of enthusiasm over AI, and I think we all hope that plays out and lifts productivity. But at a 25 forward multiple, that's a pretty steep forward multiple, especially relative to where the forward multiples were in Infotech the last time the rate structure was this high. I would look at a sector that maybe is more defensive, that's also sold off really hard over the course of the last year plus. And that sector, I think, is Utilities, not super exciting, but we almost had a 30% collapse in the utility sector as rates have surged. And in our work, that sector now is on the top of our rankings. And it's also a defensive play. So if you're worried about the end of the business cycle, the Fed tipping us into recession with higher for longer, or threatedly if they start hiking rates again, I think that area is interesting here.
That combined, the liking of the utilities combined with what you were just saying about rates, just real quickly here, do you think we've seen the ceiling in the 10-year and in the 30-year in yields?
Yeah. Well, maybe I'm the wrong person to ask, because I thought we already did. So admittedly, we've gone up a bit more than I expected. I was pretty bearish on the treasuries in 21 and in 22 for most of 22, but once we got materially up above 4, I was kind of thinking, if inflation's peaking, maybe we're seeing the top in yield. So we made a run almost at 5% this past week. But I don't think that that those yields are going to be sustainable. I mean, ultimately, you do have an economy that is decelerating on the back of the tightening the Fed's already done, and there are lags. And so as those lags unfold, I think we're looking at weaker economic conditions. Inflation eventually will come down. And so I think that the bond yields will ultimately be headed lower from current levels. And the way I would play that would be through the utilities rather than a sector that's carrying really steep valuations now, which really need everything to go right to sustain those valuations. So I would look at more defensive categories that have been hurt by the rate shock.
All right, Michael Darda, Roth, MKM, Chief Economist and Macro Strategist, and Klaus, we thank you both for your time today.
Thank you, guys.
Shares of Fastenal popping after the company beat third quarter profit expectations, generating $30 million in sales per day in September, the first month in the company's history to do so. So this one, we got an earnings beat. Julie, Jefferies, which by the way has a hold on this one, they're on the sidelines, telling their clients quarter was a modestly positive tailwind. So that's about what you would expect from a hold. That kind of, it's all right.
Yeah,
it's okay.
Exactly. They have a certain lens through which they see it, I guess.
It's all right. They said that reflects a more normalized pricing environment. Looking at peers too, by the way, I was just seeing who might have been picking up on this. Looks like names like W.W. Granger, by the way, were also popping.
Yeah, when you look at some of the other commentary around this here, Raymond James has an underperform on the stocks. They say that the EPS mildly beat estimates here and that the price to cost ratio was positive for the first time post-pandemic. So that also sort of some grudging praise. But Fastenal in the industrial category here, they make fasteners and other types of tools. So it's interesting to see a little bit of improvement in something like that. And it's one of the best performers in the S&P 500
Nice
today.
pop.
Yes. Let's talk about another mover, this one in the tech arena, and that is Broadcom. The company's acquisition of VMware reportedly expected to be approved by China soon. According to Deal Reporter, the deal likely to be granted conditional Chinese antitrust approval, which would be another step towards its getting total approval for this more than $60 billion acquisition here. VMware shares, by the way, had also been rising on this. And the company has said that it expects the transaction to close by October 30th. So obviously would need to get all of the approvals in line. And this seems to be another step in that direction.
Yeah, if you look, Broadcom CEO Hock Tan is a great earnings call, by the way. Yeah, he brings it. But he is a true deal maker, right? And he's been moving this chip maker into more enterprise software. So this would be a big step in that direction. Stock has had a great 2023, by the way. It's roared 60%.
Yeah, so I don't know if the AI play is part of that. I feel like everything chippy and techie is getting some of those plays.
And lastly, your shares of Hormel Foods taking a dive. That's after presenting its 3-year financial targets and reaching a new labor agreement. Union saying members at Hormel's locations in Minnesota, Georgia, Wisconsin, and Iowa voted to ratify a contract that includes the largest wage increase in the company's history. So this one, Hormel, the food maker, Julie, so laid out this plan, had some financial targets. But analysts are noting, by the way, the company is calling fiscal 24 a year of significant investment, right?
Yes.
But really, this union news also making a lot of headlines here too. Hourly wages increased $3 an hour to $6 an hour, among other benefits.
Yeah, and obviously there's a lot of attention on any union activity right now within the corporate world and the impact of that. At that investor day, the company talked about that $250 million in operating income growth by 2026. Just for context there, the company's operating income estimate for this year, it looks like is $1.18 billion. 2026 would be $1.495 billion here. So if you're looking at the growth over that time, it does seem to be roughly in line with estimates. So it's interesting that we're seeing the stock take such a hit. It might indeed be exacerbated by some of that union activity.
Yeah, this continuing trend we talk about all the time. This union activity across so many companies, so many sectors and industries, in some cases able to go to the negotiating table, secure a better pay deal for their members.
Yeah, we'll be tracking this one in particular. And we're just getting started here on Yahoo Finance Live. Coming up, housing hurdles. Mortgage rates tick up again, offering no relief to home buyers. We'll get you the latest numbers. And the incredible sinking stock. Shares of Birkenstock are falling once again today after the public debut yesterday. We're going to break down the reasons behind the plunge and what it says about the bigger IPO market. And tech titans, Google and Amazon, hit with new attempted cyber attacks. This comes after the recent MGM and Caesars attacks. What's with the uptick and what are companies trying to do about it? We'll talk about it when Yahoo Finance returns.
United Auto Workers Union expanding its strike again, this time hitting Ford's biggest truck building plant in Kentucky. It is the automaker's most profitable plant, bringing in around $25 billion each year. Analysts have previously said the strike hasn't been that concerning because truck plants have been spared until now. David Whiston, Auto's equity strategist and Morningstar Research, joins us now. So, David, let me ask you, this feels like a fairly significant escalation here. Is this how you saw it?
Yes, definitely. This is basically with the Detroit 3, it's all about full-size SUVs and pickup trucks. And with Kentucky Truck, you're really going after both because you're getting part of the F-Series franchise with the Super Duty production, but then also Expedition and Lincoln Navigator. Probably not a surprise given last week the UAW said they were on the verge of striking GM Arlington, Texas, where they make all their full-size SUVs. So unfortunately, there's probably more to come on this as soon as tomorrow.
I mean, David, what does this tell us about what's going on behind the scenes in the negotiations? Does it signal that there's not progress and that's why the UAW felt like it had to make this move? And does this then in turn put more pressure on Ford and really, get them to make a deal?
Yeah, Ford had a press conference actually just before we went on the air here, and I was listening to it, and they, from the Ford perspective, they thought they were making progress on issues like the battery JV plants and retirement benefits. The union clearly feels differently, and I think the union's just taking a more absolutist approach of, if we don't get what we want, we just keep escalating the strike. And this week it's full-size SUVs, and then I think now that we're into the most lucrative vehicles and probably Ford's most profitable plant, this plant does roughly $5 billion a year in EBIT for Ford. The question that, and hopefully management has already made a decision here, but what they need to do at all three firms is decide, do they want to end this strike soon and perhaps give in to avoid the bleeding in pickups and full-size SUVs? Or are they willing to wait this out? And to wait it out, they're going to have to lever up the company probably. And the math is, I think, on their side to do that, but you have to take a lot more debt. That's going to in turn drive your stock price down quite a bit.
And David, this latest action by the UAW, in addition to financial implications for Ford, are there ripple effects for suppliers as well?
Yeah, that's a very underrated aspect of this strike. I mean, the UAW, of course, cares about its own members, but there's so much ramifications, not just in the auto supply chain, but throughout the whole broader U.S. economy. I mean, generally, an auto manufacturing job is roughly a multiplier effect to me as much as 8 to 10 other jobs in the economy beyond the auto sector. Just in the supplier space, trade organization this week is saying 30% of suppliers at the Detroit 3 have done layoffs. They think that percentage, I think, is going up quite a bit, maybe doubling, if I remember right, very shortly. And those workers, they're not going to come back to work. The supplier side and everyone else impacted by the strike, directly or indirectly, they're not going to come back to work eventually with a fat new contract like the UAW workers will. They're just going to get to come back to work. And then things like restarting plants, these smaller suppliers, they have negative working capital for them to restart. They may not have the funds on hand to do that. There's been, the trade organizations are asking President Biden to give some money to suppliers who have under $200 million in revenue. We have to watch this pretty carefully because it's not going to be Lear or Magna, a big tier 1 supplier, that's going to take down Toyota and everyone else. It's going to be some random tier 2, tier 3 supplier that nobody's heard of, if it happens.
When you say explain to me exactly what you're saying here, David. If one of these suppliers you're saying might run out of money, might run out of operating funds at some point if their largest customer is not taking orders, and then maybe they go out of business, maybe there's a ripple effect. Is that what you're outlining here?
Basically, yes. A very small supplier, which generally in auto industry parlance is called the tier 3 supplier. So tier 1 supply to the automakers, and you go upstream from there. They can go multiple layers all the way generally to a tier 3. The tier 3 could run out of money. They could run out of labor. Those are people who have been shut down because of the strike. They need to work, so they've left the company. And then to restart, it can be very difficult if you don't have the funds or the people. And then on the actual production, to your question, this is where I've said in the past, this is not just a Detroit 3 problem or just a Midwest problem, because that tier 3 supplier feeds a tier 2 supplier, feeds a tier 1 supplier who feeds the Detroit 3 and Toyota, Hyundai, Kia, Honda, everybody else. or a lot of the other firms that aren't UAW, it can impact all of North American auto production potentially. But I'm not saying we're on the verge of that, but that risk is there.
David, I'll get you out of here on this. I'm just curious who you think has leverage right now in this fight. You know, I look at UAW's Sean Fain, and he's seeing the same polls I am. There's a recent one from the AP, David, saying a majority of Americans support higher pay for auto workers. He knows he's got the president of the United States on his side. Biden has shown clear solidarity there. And given this targeted strategy he has of when to strike, he's not exhausting his strike fund. Do you think Fain actually is in pole position here? Who has the leverage?
Yeah, I think that goes back to what we were just talking about. It depends. Do the automakers, are they willing to let the strike go a long time and lever up the company? If so, I think the automakers ultimately have the upper hand, even though right now I think it does look like the union's winning because they keep getting more concessions. But as the union keeps escalating, that increases the depletion rate on the strike fund to the point where if you shut down all the Detroit 3 at once, even when the strike fund was full, you had, I think, roughly 6 or 8 weeks. I can't remember the number exactly of calc, but $500 a week of strike pay, even if they're not paying healthcare, $500 a week of strike pay, $825 million to start. That depletes very quickly when you're talking about roughly 146,000 people. So it just depends on, will the automakers be willing to let the strike go a long time, or do they want to end this soon? But if you're talking, in order to end it soon, if you have to do things like pensions, retire your healthcare, I don't think they're willing to do that because they know it's going to kill them.
David, really helpful perspective here. I mean, we've heard all the big numbers about the strike, but it's really great to get sort of the breakdown of the costs of this and not just for the big three themselves. Thanks a lot, David.
Thank you.
Mortgage rates climbing for a 5th consecutive week. Yahoo Finance's Danny Romero is here now with the numbers. Danny, we're not quite at 8% yet, but we keep getting closer.
Julie, another blow to potential home buyers. Freddie Mac reported that the 30-year fixed mortgage rate hit 7.57% this week compared to last week, where it was 7.49%. Like you said, we are getting closer and closer to that 8%, squeezing purchasing power. And again, it's important to highlight that this is the 9th consecutive week where mortgage rates have hovered over 7%. The misery of a high interest rate environment is likely not going to go anywhere, but it's not all bad news. Household incomes continue to grow, but looking ahead, taking into account housing data, buyers are still bummed out about the housing market right now, given the higher interest rates. Another thing to point out is Fannie Mae came out with a survey that says that 84% of their respondents said that it is a bad time to buy a home. And another similar share say that they expect that these higher rates are likely going to continue to this elevated pace. So really no relief ahead, Julie.
And Danny, CPI showing housing costs jumped the most in months. What does the shelter component of CPI signal ahead on that housing front?
Josh, housing costs are still frustrating the Fed's fight against inflation. The shelter index from the CPI report came in at 0.6% increase over the last month. Also, it hit a 7.2% on a yearly basis in September. So once again, another big contributor to the monthly increase in inflation. And some reaction from Wall Street, some economists have been that the results of the shelter index was a lot larger than expected. Some economists were expecting some disinflationary momentum, given the fact that real-time data shows that rents have come down, have flattened out on a yearly basis. But remember, CPI is a lagging indicator from real-time data. So what does this mean looking ahead? Some economists expect that the rent portion of CPI, which is a little over 7% of the CPI number, some economists are expecting a 0.5% increase on a monthly basis. And we can start seeing some of that downward pressure in the shelter component as soon as October, November, and December of this year. Josh?
Danny Romero, thank you so much. And coming up, Birkenstock tanking since its IPO on Wednesday. What does it say about the venture capital space? We're going to break that down next. Stocks are off their lows today, but the real move for markets, bonds. Jared Blickery is here on the floor of the New York Stock Exchange with a closer look. Jared.
Hey there, Josh. Let's go to the Wi-Fi Interactive so we can plot the day's price action. I'm going to use the S&P 500 E-mini futures here so we get the entire picture. First, we got a little bit of a downdraft at 8:30 a.m. on that CPI report. Came in a little bit hotter than expected on the headline number, but not by much. As expected on the core number, nevertheless got a little bit of a downdraft. Now, afternoon, we had climbed back up into green territory in the futures, and then at about 1 p.m., and Julie, you flagged this in one of our Slack rooms, there was a 30-year auction, did not go that well, not as much demand as the market thought there would have been, and we saw yields accelerate to the upside, and stocks took a definitive leg down. That's pretty substantial there. Let me just show you what happened in the 10-year T-note yield, and you can see there, it's been not as dramatic a movement to the upside, but we are up 12 basis points, and then I mentioned that was a 30-year auction at 1 p.m. That is up even more, 13 basis points. And if we take a look at the entire U.S. yield curve, as we have here from the short side all the way at 1 month to 1 year, all the way up to 30 years, over the last day, we have moved up, and over the last month, we have moved up substantially. This purple line at the top is where we are today. This cyan line is where we are yesterday, and the orange line is where we were 1 month ago. As you can see, the long end of the curve by 10, 15, 20, 30 years, all of that has accelerated to the upside, and this is having a pronounced effect on equities. Now, why does this happen? It has to do with leverage in the bond market. Bonds are supposed to, especially U.S. Treasuries, are supposed to be grade A, very much a safe haven, and when they are volatile, though, they take a haircut for regulatory reasons and for just margin reasons. If you want to post a Treasury bond that's been moving a lot in price recently, guess what? You're going to have to post more margin. That eliminates room for other things like risk markets, like stocks. And so when we see these big movements in the bond market, that just spills over into everything else. And that's what we're seeing here. I want to show you another chart here. This is the S&P 500 going back 6 years. And all of these pink dots here, all of these are when the 10-year T-note yield has moved by more than 10 basis points to the upside. What you notice is that in 2022, when we had that big downdraft, that's when the Fed was raising rates aggressively for the first time in probably 4 decades, the way it had been. We saw a lot of disruption in the equity markets. We're still seeing those, not quite as frequently, but it's still a common occurrence. And all of this is just to say that there's probably more hiccups to come before this all gets sorted out. I'm going to leave you with a look at, this is a 5-year chart of SPY, which tracks the S&P 500. That's the gray line. In blue, we have what the market does on these CPI days. You can see we have not had a drop like we had today since basically when we were at the bottom or towards the bottom of that downdraft that we had last year. So something to think about as we go forward. These higher rates are just giving the market something to worry about and are a little bit tough for risk markets to handle.
Love those charts today, Jared, especially those pink dots. Keep it coming. Thanks so much. Birkenstock shares sliding once again on the second day of trading after its disappointing public debut. The lackluster performance adding on to an already shaky IPO market. Other recent public debuts like ARM and Instacart have been struggling since their offerings. Here with more on the path forward for the IPO market is Kyle Stanford, PitchBook U.S. Venture Capital lead analyst and University of Florida professor Jay Ritter, who also keeps a close eye on this market. Guys, thank you so much for being here. It has been a very interesting couple of months on this front. Kyle, I'll start with you. When you look at, Birkenstock sort of stood out even more than some of the other lackluster IPOs as of late because of the pricing and then the action. What sort of takeaways do you have from that?
Yeah, I think in reality, right, when you look at what's happened with the recent IPOs, it has not been the performance that anyone has wanted, right? There's still a lot of uncertainty in the public markets. Obviously with everything happening in Israel and still in Ukraine and the tensions between China, those are just adding more uncertainty to the market, and these companies that are coming to with these IPOs are just not finding the interest that they were hoping for. We track the Instacarts and the Klaviyo's much tighter than we look at the Birkenstocks, and those too, right? They turned profitability, they turned kind of the where they thought investors were looking for, and they still have not performed well. So it doesn't bode well for the rest of, the rest of 4Q or even, early 2024.
And so, Jay, let me turn to you. When we look at these names that have made their debuts, so ARM, Instacart, Klaviyo, now Birkenstock, in trying to explain that kind of lack of appetite here, Barron's said this, Jay, and I want to get your reaction to this. Barron's trying to make sense of all this, says one issue could be that the advisors don't have a good understanding of how these companies should be valued. Barron's goes on to say they've misjudged the advisors' current market conditions. What's your reaction to that, Jay?
I think a big issue has been the reset in valuations for growth companies. In 20 and 21, we had the big run-up in a lot of growth company share prices. 2022, a big reset where, largely due to rising interest rates, investors started assigning lower multiples. And then with individual companies, analysts, investors have to figure out what is the potential growth of profits for this company. With young tech companies, typically that future growth is a really important part of their valuation measure. With a company like Birkenstock, which is much more mature, there's less uncertainty, but there's still uncertainty about its ability to grow future profits.
Well, and what's interesting here as well, Jay, about Birkenstock in particular, is that it does actually make profits, which is not necessarily a given for companies that are entering public life. At one point, when you talked about sort of the go-go days of 20 and 21, it didn't seem to matter. Then it seemed to matter again, whether companies made money. But now you're saying we're really getting another change to wanting to see that steady growth of profits. Is that going to mean we're not going to see as many companies come public, for example?
Well, I think we're going to continue to see slow IPO volume for another year or more. After the big drop in 2022, in the past, it's frequently taken several years before IPO volume has recovered to average levels. And I think we're in one of these multi-year periods where it's taking IPO volume to recover over a multi-year period. But even though Birkenstock and ARM are profitable, there's still questions about how much can they grow future profits. ARM is selling at a pretty high price-earnings ratio, where investors can only justify that by assuming that it's not only profitable now, but it'll be able to grow profits substantially.
And Kyle, what interests me too is just that we find ourselves in a different environment here where for the first time in a long time, there are alternatives for investors. They can duck into T-bills, they can move into money market funds yielding 5%. How does that also kind of impact and influence the IPO market and risk appetite?
It definitely impacts it, right? Especially when you talk about these VC-backed companies that are supposed to be high growth, have really high valuations. They're much more risky investment for the near term and the long term than some of these other, T-bills, like you mentioned. There's a much bigger appetite for those, for hang out on those for 2 years and then come back and see where the market's at. But right now, these high-risk tech growth stocks and IPOs are very are not receiving the interest, obviously, that many were hoping.
And Kyle, when we look at the pipeline, if you will, of companies that are sort of getting close to IPO, or some of them we've been talking about for several years, what does private market financing look like right now? Will some of these companies be able to just continue on as private companies without having to tap the public markets?
Yeah, so this is actually a really big problem right now for late stage and venture growth stage companies. The capital availability in the private markets is just not there like it was 2 years ago. And so it's going to be really difficult for this stage, or the companies at this stage, to continue operating as private companies. 2 years ago, hedge funds, mutual funds, private equity firms were very active in this space, and they were pumping in a lot of dollars. And now that those dollars have moved back to their more traditional strategies, the capital that is available for late stage and venture growth. And I want to mention that those two stages have now doubled in the number of companies that are still private within them in the last 8 years. And so there's a huge number of companies that need capital. Without the IPO markets, without the capital availability in the late stage, it's a really difficult market for these companies.
And Jay, I want to end here with you on this. So we're talking about a lot of different headwinds and challenges for the IPO market. What about, Jay, also just this enormous pool of startup employees who are out there? And, Jay, they are waiting for this liquidity event. And if it's not going to be an acquisition, they're waiting for an IPO. They have life costs like everybody else. How much of a tailwind is that for the IPO market, do you think?
It's something that's definitely a factor. There are some liquidity options like Nasdaq private markets for typically venture capital-backed private companies, but that's certainly not the same level of liquidity that you get as a public company, either having gone public through an IPO or direct listing, or the last year and a half, quite a few companies have gone public by merging with a SPAC. That avenue for going public, however, is slowing down, and I expect it will continue to slow down substantially even as the traditional IPO market recovers.
Kyle Stanford and Professor Jay Ritter, thank you both so much for your time today.
Yeah, thank you.
You're welcome.
And coming up, the CEO of AMC says he was the target of a blackmail plot. We're going to break down what it could mean for the theater chain. AMC Entertainment CEO Adam Aron says he fell victim to an elaborate criminal extortion last year. The chief executive writing in an X post this morning that the extortionist was by a third party who was known to him, and he has since been convicted. So this one is interesting, Julie. So he didn't pay the blackmail here. He reported the events to the FBI. Of course, we all remember AMC, probably a lot just during the meme stock craze,
right.
GameStop, BlackBerry, and others. And Mr. Aaron, of course, got read in there calling himself the Silverback, I think is the nickname.
Because the apes are the fans of the stock.
Right. So, I mean, I guess one question people had was, why does it matter maybe so much? Because it is...
Well, let's be clear what we're talking about here for a minute. So he put this post on Twitter. He didn't really say exactly that he was being blackmailed, this person extorted him. Then on Semaphore, Liz Hoffman reported that he got catfished is effectively what happened.
Right.
A woman had texted him. He sent her... allegedly sent her explicit photos and texts. So that's what happened. Now, to your point, yes, does it matter? Is it relevant to his leadership at the company? But let's be clear what we're talking about. I mean, I think you could argue both ways.
One argument was, and he himself says this was a personal issue.
Yes.
Right. There's no reporting here, certainly, that he in any way divulged or compromised company data or information. But I guess the reporter was making the sort of the counter argument in Semaphore. Perhaps it is an issue of judgment. I think
I think that's a fair argument to make, and it's you look at and Hoffman she also pointed out some of the other things that he has done. He bought a gold company, for example, or not he. AMC bought a gold company.
Moving to NFTs, remember that one?
So he's done some other things that you could say, but in
appeared
this
like he wasn't wearing pants in a 2021 interview.
Exactly. But at the same time, there is this certain cult of personality that surrounds some corporate leaders when you have this huge retail investor following like AMC does, where it's not seen as a negative for him to do things like this. And indeed, the stock has been trading higher today. So obviously, Elon Musk is another example of things like this, where he does things that you could say don't exhibit the best of judgment and yet is not punished.
Yep. He has his fans.
Yes,
and so does Adam.
exactly.
Tech giants Amazon, Google, and Cloudflare warning of a massive denial of service attack started back in August. The company's saying it's a new kind of attack, but they've been successful at fending it off. Joining us now is Morgan Wright, SentinelOne Chief Security Advisor. So Morgan, let me just get your take on this latest news, this latest headline. What was your response to it?
This would be like one day you're watching Wilbur and Orville Wright take off in their little plane, and then 2 months later you wake up and we're putting men on the moon. That's the order of magnitude of impact this type of attack has happened. It's gone from, what they thought one of the biggest ones, maybe around 4950, what they call requests per second, to almost 400 million requests per second. Anybody else, this would have just completely taken them offline. But Google, Amazon, Cloudflare, they were able to kind of prevent this and mitigate it, but this spells problems, especially for other companies who don't have the extensive bank, the bank account and the technology and the capability that these big companies have. This could be something that could be very impactful, especially considering the situations around the world where the need to get information out is so critical.
Morgan, there's the capability on the part of these companies to defend themselves. And then talk to us about the other side. Who is perpetrating these attacks? What are they trying to get done? And what kind of resources do they have?
There hasn't been really credible reporting yet on who's been behind it, but there's usually two things. Number one, if it's a state actor, it's done to, gain some type of a strategic advantage or to take us offline. If you think of China and Taiwan, the situation in Ukraine, what's going on with Israel and Hamas right now, there could be some nation state actors. But on the criminal side, it usually involves money. Criminals don't do anything for those things. Their motivation is money. So you're looking at what is it they hope to do. But then there's potentially a third one, which are just basically, digital anarchists. They just want to disrupt things. So it's not clear what it is, but what is clear is that whoever figured this out, this may become part of the toolkit that's used later as they build out bigger malware packages and bigger types of attack platforms. This could be part, and this was a proof of concept. They tried it out. They found out it was effective, even though it was mitigated. This could become a huge tool in a new toolkit that's used on companies, again, not the size of Google, Cloudflare, and Amazon.
And Morgan, I'm interested to get your take. When companies find themselves in trouble like this, should they be paying ransoms, in your opinion? I know that's it's a subject that gets debated and discussed a lot. Interested in your view.
Yeah, obviously at SentinelOne, we've got a point of view, which is if you defend and protect yourself, the use of AI automation, you can mitigate a lot of that before it happens. If you do get hit, the FBI has even said, look, people who pay tend to get hit again. So what you're trusting is that a criminal who has already breached your confidence, breached public trust by attacking you, you expect them to be ethical and give you back all your files. So, the best thing is not to have it happen, but if it does happen, you look at what happened with MGM and their refusal not to pay. There is a cost involved with it, and as long as you're willing to bear the cost of legal, rebuilding systems, it's never good business to do business with criminals. But there's no easy answer to that, except there is one thing. You have to be very careful. If the ransom money is going to an entity that's on the OFAC list, the Office of Foreign Asset Controls, and it's supporting terrorism, the U.S. Treasury could actually sanction you for paying a ransom if that money can be tied to going to a terrorist group.
That's a very interesting point, and it's a good reminder, especially right now. Morgan, you mentioned the MGM hack, and there was also one against Caesars. It feels like, there are certain moments where it feels like there's an uptick in these sorts of attacks, at least from an anecdotal basis. Is that actually what's happening, and what do you think could be driving that?
Higher education is getting hit. Education's getting hit because they're fairly open and they don't have the extensive resources. But, you bring up a good point. Hackers don't break in anymore. They log in, and the MGM hack started with somebody trolling LinkedIn, scanning LinkedIn, finding somebody, and then impersonating an employee to the help desk to get credentials. So it's really, if you get that initial toehold in, you can do it. So we do go through cycles, we do go through seasons as people get better at defending these attacks, then new ways, new vulnerabilities are found, new groups come out. And then they attempt to do that. But what we're finding right now is a lot of these breaches are happening not because they're exploiting a vulnerability in the system, but because they're getting initial access by exploiting identity and access management that way. So there's kind of a, as we get better at one thing, then it's the other thing. I always tell people the problem isn't the problem. The problem isn't the way you think about the problem. There's only one problem that matters, and that's how your adversary thinks about the problem. And criminals think differently than law-abiding citizens, and that's kind of the advantage they have many times.
And Morgan, we talk a lot on this show about the boom of interest in generative AI. I'm interested, how can that technology kind of change and impact the cybersecurity landscape?
It's huge. I've done a lot of work, both in law enforcement, the intelligence community. We look at how this has progressed to the point of where now the real issue is if I can put out something and it's fake and you find out 2 hours later it's fake, it doesn't matter. It's the impact it's had in those 2 hours. That's the real impact we're going after. I did a segment one time with the mother whose daughter's voice was cloned using generative AI, and it was a kidnapping, and they were wanting ransom. Even the mother was fooled by the generative AI. So look, we've got the political season coming up on us. I'll tell you what is really right for this. It's the terrorist attacks by Hamas against Israel. The ability to take video now or other things and wrap other things around them to make it appear to be real, but it's not. That can actually spin up military actions or cause protests. These things could have a real impact. I'll tell you, that's one thing I've been worried about for a long time is the impact AI will have and in our ability to detect these fakes, detect these deceptions before they've done their damage.
Well, it's a scary world indeed when we can't believe our eyes or our ears for that matter. Morgan Wright, thank you so much for flagging all of this and explaining it to us. Appreciate it. Coming up, we've got the closing bell on Wall Street. We'll be checking on the latest market moves and the top trending tickers. Keep it right here. Well, we just saw the closing bell. Just saw the closing bell on Wall Street. Let's do a quick check of the markets here on this Thursday. We had quite a session in terms of the bouncing around. Jared Blickery did a great job of laying that out earlier, a lot of it driven by the CPI this morning, and then a bond auction at 1 p.m. that drove rates higher and stocks lower. But that said, we're finishing off the lows of the session. The Nasdaq down about 0.6%, as is the S&P 500. The Dow off 174 points, or about 0.5%. And we have been seeing some of the interest rate sensitive groups that had been leading the declines today. Let's also check on some of the individual stocks that we were watching over the session. BNP Paribas downgrading Carvana to neutral from outperform. That downgrade coming just days after competitor Shift Technologies filed for Chapter 11 bankruptcy. Shares of Carvana, I should say, down about 10.5%. And the analyst over at BNP Paribas was one of the only two left that had a buy equivalent rating. Yeah. And to be fair, the shares are up, 600% this year? Yeah. But they are down. They came public back in 2020 at $45 a share, and they're down about 25% still since
So this
then.
analyst had been outperformed since October 2020. Long-time bull. Now moves to the sidelines with a neutral. Price target goes to 37. Less confident, the analyst says, now in the unit growth. And by the way, so now that he's to the sidelines, you have just one bull left on the street. I don't know if is that a contrarian indicator? I don't know. Is that?
I mean, it's already up 600% this year, so
I don't know.
I don't know. I mean, Carvana has just had a very volatile, tricky period of time that has governed it. We are also watching Netflix today. Netflix says it's going to open branded retail stores that are going to be called Netflix House. This, according to Bloomberg. The streaming giant will have venues that will feature a mix of retail, dining, and live experiences. The share's down a little bit today, about 1.25%. But, you know, there were some wags on Twitter who were saying, you mean like a Blockbuster? But I think it's going to be more like a...
Come on, there's dining, apparently.
Yeah, what is this going to... I don't know.
There's not a ton of details here. There's not a ton of details. I mean, maybe it's like, it's going to be some retail, some dining, some live experiences. We don't have a lot. It's sort of the evolution of Netflix. So the DVD to streaming, and now maybe a Squid Game store.
Like a Hard Rock Cafe, maybe, but like for movies and shows from Netflix.
That doesn't sound fun at all.
What's also, the company has had some pop-ups. Something called the Queen's Ball, a Bridgerton experience, where I guess you go. I don't know if people dress up, but you can go and hear music like you hear in the show, and dance and drink. So what strikes me about this is that it does seem, at least from what I've seen initially, decidedly grown up, right? You think of, so it's not like it's going to be competing directly with, say, a Disney type product, a parks product. It seems like it is going to be more adult aiming. And if you think about the ecosystem that exists not just around Netflix shows, but you think about the recaps that you read, the Easter eggs, there's so much of an ecosystem around many, many shows. It kind of makes sense that you would then be able to transport that into that's what fuels the likes of Comic-Con, for example, right? Where people gather in person to discuss things that they have read or watched or followed. So I don't know, it's sort of an intriguing concept.
I mean, you mentioned Disney, which is a great example. There's an entertainment company, theme parks, clothing, leveraging the IP, leveraging the characters. If you came to my house, you would see how well it's working. Frozen everything from blankets to toothbrushes. And listen, Netflix looking for different revenue streams. You could argue, why not try this? It'll be interesting, though, who is the target audience?
Yeah. Well, how many Hellfire Club T-shirts have you seen, right, from Stranger Things? Like, you do see...
Yeah. Well, they've got the merch shop. I know
you just discovered the online merch shop.
I got sleeping bags here. I got whatever you need. Yeah.
All right. Well, we'll get the opportunity to see all that in person, I guess. X, the social media platform formerly known as Twitter, is being probed by the European Commission over the spread of, quote, violent and terror-related material connected to the war in the Middle East. The EU's industry chief has given X a 24-hour ultimatum to stop the spread of misinformation, citing a new digital media law. X CEO Linda Yaccarino says it is taking action to delete accounts or label thousands of posts related to the conflict that was incited by Hamas over the weekend. Joining us now is Yotam Ophir, University of Buffalo communications professor. Obviously, this has been a persistent problem for social media companies. Yotam, And you could argue it has only gotten worse under Elon Musk and Linda Yaccarino, and now this conflict even more highlighting it. How does X even begin to sort of try to fix this problem?
I don't think that X or Twitter before that are even trying to fix the problem. I think that the flow of information in an unfiltered way was one of the things that Elon Musk was aiming for. Since he took over the company, content moderation had been non-existent, with a sharp rise in anti-Semitic, racist, misogynistic content, and these days misinformation connected to the conflict in the Middle East.
Yo, Tom, would X say in response, what about community notes as a way to correct misinformation?
The amount of misinformation on X is beyond something that individuals like you and me can fix. It's a systematic problem. It's a problem that has to do with the lack of regulation in the United States. I'm happy to hear that other countries, including the European Union, are moving towards doing more. But at the moment, putting the burden of identifying truth and false during a conflict full of uncertainty on individuals, on citizens, on users is just not reasonable in my view.
Do you think then that the U.S. does need to regulate this as well?
Absolutely. For many years, we decided to treat technology companies like Twitter and Facebook as if they have nothing to do with media. We basically, due to something called Section 230, we decided that they are not responsible for anything that's happening on their platforms. The result was that the only motivation that big companies, tech companies have these days to moderate information is if it hurts their bottom line financial interests. We must do more to regulate the flow of information in today's information reach and misinformation reach environment.
Yo, Tom, what about the criticism? And I know you've heard this from folks who say the problem is that a lot of times what we label as misinformation doesn't turn out to be that at all. Or perhaps, I mean, an example, and I know you've heard this, I'm sure, is, spring of 2020, Tom, there were people saying, well, maybe the coronavirus didn't actually sort of spontaneously erupt in nature. Maybe it was actually from a lab in China. And go back to spring of 2020, that was misinformation. If you said it, you were a conspiracy theorist, you were a racist. Social media companies got to work snuffing out that idea. Spin ahead, report after report indicates, in all likelihood, that could be exactly what happened. Do you think there's a risk there that you label things misinformation, you get it shut down, but it's proven not to be at all?
Let's clarify here that at the time when people were spreading the lab theory, it was a conspiracy theory. Some of the things that we believe are true turn out to be wrong, and some of the things we believe are wrong might turn out to be true in the future. We're not prophets. All we can do is make sure that the spread of information that at the moment is thought to believe to be false and misleading is being isolated or by the very least not amplified on social media. I will say that in addition to the need to moderate misinformation and conspiracies during time of crisis like this, we should also expect those companies to do more to limit the amount of hate speech against racial groups, against ethnicities, against women or the LGBT community and others. So it's not just about misinformation.
In this case, though, Yotam, what I think is perhaps a new ratcheting up of this is, and I know you've studied sort of how this misinformation can affect how people feel and what they think. In the case of this war, there's even potential for it to affect the decisions that are being made on the ground, right? If there is actual, not just misinformation, but as our previous guest was talking about, doctored videos that seem real, for example. It seems like that there is now even a new risk that if there are decision makers that are seeing these videos, are they making decisions based upon that?
Well, we have to hope that decision makers have more reliable sources than X or Facebook, but I absolutely agree with the previous guest that it's getting harder and harder with the advancements in technology to identify deception online. It's becoming significantly easier to doctor an image or to alter a video. And we saw in the past that you can even make a world leader seem to be saying something that they didn't, and so on. I'm truly hopeful that those who make the actual decisions have more reliable sources. But for the rest of us, we should be very careful with what we are believing these days, with what we are sharing with others. We should focus on reliable sources, avoid partisan media and bloggers or all kind of pundits that are known to spread misinformation, and put our trust in fact checkers and established media, again, that proved to be reliable as possible in the past.
Yotam Ophir, University of Buffalo. Thank you so much for your time and insight, Yotam.
Thank you.
And coming up, companies are increasingly touting their use of AI. We're going to tell you how one business is using AI to help save you time and money. We're going to break it down next.
The Social Security Administration has announced the cost of living adjustment for 2024, but retirees can expect a much smaller raise in their benefit checks next year. Here with the details, Yahoo Finance's Carrie Hannon. Not as big inflation, so I guess not as big an adjustment, right, Carrie?
Yeah, so on one hand, that's good news, but I think retirees are going to see an increase of 3.2% cost of living adjustment in their checks starting in January. Now, that is, significantly higher in many ways than the 2.6% that they saw, over the past 2 decades. But let's think about last year's was a big whopper. Last year was the biggest in 4 decades. So what we're seeing this year is about half of what retirees got this current year in their Social Security adjustment. Now, the thing is, people may whine about this, like, oh, it's, why is it so much smaller than last year's? But the truth of the matter, as you alluded to, is, in fact, it shows that prices are stabilizing. And this is a good thing. It's better to have stable prices than a big cost of living adjustment moving forward. So that's one thing. And really what this comes down to for the average retiree's Social Security monthly check is about a $50 increase, maybe a little over $50, I should say. So that's what we're seeing there. But what's interesting is that, if you look at how this is calculated, a lot of people are confused by how they come up with this number. They take the inflation number from the CPI, the Consumer Price Index for urban wage earners, and that's for July, August, and September. They average those together and look at what it was last year at the same time. That's how they come up with the number, and it is a once-a-year adjustment. But the beauty is it does adjust for inflation, and many investments people have do not. So to have an income stream that does adjust for inflation is a good thing. But the thing is, there was a study that came out recently from the Senior Citizens League that said, seniors are still worried. They say that their household expenses are running 10% above what they were last year. So is it enough? Who knows? But it varies across the country. But in general, this is good news.
Carrie Hannon, thank you.
Thank you.
The latest inflation data is out, and it shows the price of sugar on the rise, but it isn't expected to put a damper on Halloween celebrations this year. Yahoo Finance's Brooke DePalma is here to tell us why. Brooke.
Good afternoon, Josh. That's right. Sugar and sweet prices jumped in the month of September. They were up 0.3% on a monthly basis, was then contributed to a year-over-year jump of up 6.5%. Now, this comes as sugar futures were up 40% compared to a year ago. And prices are high, and they ultimately are remaining high because of a lower global supply of sugar that we're seeing. Now, extreme weather is to blame for that impact on global sugar supply. Countries that are major exporters like India, like Thailand, like Australia are suffering from what they say are a really dry monsoon period, and ultimately that is impacting the amount in which they are producing. Now, another contributor to these higher costs is cocoa futures, which one expert said is a bigger chunk of the total cost of manufacturing for candy producers than sugar is. But yet, the good news here is that Americans are so eager to celebrate. More consumers are gearing up to celebrate this Halloween, especially post-pandemic, and they're tapping into nostalgia here as well, celebrating this. And higher prices also contributing to a record high of candy sales. This year's $3.6 billion in candy sales are expected to hit a record high according to National Retail Federation. We also are expected to see 3/4 of Americans celebrate. That's up from last year. But one fun fact here is that 9 out of 10 Americans are expected to wait and look for a good deal in the last 2 weeks of the holiday season. And Josh, Julie, I have to say that I have not done my Halloween shopping just yet. I am one of those people that is waiting for a good deal, and I can't wait to grab my favorite, which is Reese's, coming out at hopefully, they're already on the shelves. They've been on the shelves, I feel like, since the middle of the summer, but I certainly will be grabbing for Reese's as well.
Wait, Reese's, the cups or the pieces? Very important.
Good question. The cups, always the cups. The pieces are good,
Okay,
but I have to go with
always
cups.
the cups. I'm with you with the cups. Josh, what's your thing?
Milk duds.
Milk duds?
Oh, milk
I'm a simple man.
duds.
A little caramel, a little chocolate.
That is a hot take, Josh.
Where do you go for? What's your
Twix. Twix is my
really?
thing.
Oh, there we go. Yeah, a mini
Very
Twix.
different.
Mini Twix, because it's
it's very responsible. Very responsible. Thank you, Brooke DePalma. Klarna is pushing further into artificial intelligence, unveiling a new feature that allows shoppers to take pictures of items in stores and find out where they can get the best deal on them. This coming amid a greater AI push for the company, which released research back in May showing 8 out of 10 shoppers look forward to having an AI shopping assistant. For more on this, we turn to Sebastian Siemiatkowski, co-founder and CEO of Klarna. So Sebastian, this is a new AI-powered image recognition tool. Just explain this technology to us, Sebastian, how it works and what it's going to mean for your business.
Well, I think that we have seen already a few attempts to make this work, right? But I think what we're traveling towards, so what we're going to see very soon actually function, and what Klarna is able to offer, is this idea that basically everything becomes shoppable, right? It doesn't matter if you happen to see something in a Netflix movie you like, or if you're seeing somebody wearing something on the street, or you're just scrolling through some social media. So like basically closing that distance between seeing content that is we want to purchase and being able to just get the AI to purchase it for you at best price, at best delivery time, and be in your mailbox very, very soon. So this is part of that journey.
Hey, Sebastian, it's Julie here. It's good to see you. Are the retailers on board with this? Because I could see in a lot of situations where it would benefit them, but I could see others where if I see a product and then I can scan it and look up other things, maybe there's a cheaper option and I'm going to get that instead.
Well, what we've seen is that I think there are two major roles to play, right? One is product and brand. People that have products and brand that are unique, that are interesting, that add a lot of value to consumers, they're going to do really well in this world. But there's also a curation role to play, which has been the traditional role of retailers. How do you curate products, like help me select the ones that are relevant for me based on my preferences? The rest is really just technology to accelerate commerce. And that's what we're trying to bring to this. Now, what we have seen also as a payments company, right, is that we understand the consumers really well. And if you think about kind of the traditional role of an Amex, it was supposed to work like that you would wave your platinum card when you come into the restaurant and somebody would be, oh my God, it's the platinum, I need to bring the best wine and the best food. So the point is that the payments company has always had an idea of being able to signal to the seller, who is this customer, what's their preference, and help accelerate their business. And this is exactly what we're trying to do here as well.
And this image recognition tool, Sebastian, what data is that tool trained on?
So I mean, we have about 2 years ago, we acquired in Europe, because Amazon was never as dominant as they've been in the US, we've had these very interesting category of businesses, which we call comparison websites, that basically help people curate and find interesting products. And Klarna went and acquired one of the biggest European players in that space. So we have over 50 million store offers in our database. We have over 10 million product items across those stores. And that's obviously the images of those that this has been trained on. But we also use and leverage the amazing technologies of OpenAI and others to make the experience really, really unique.
Sebastian, I want to turn to how you guys have been doing a little bit more broadly. Even though you're private, you did report some metrics at the end of August. And I believe you've also said publicly that you hope to be profitable on a monthly basis in the second half of this year. We're in the second half of the year. And so I'm just curious how it's going.
So my PR team have clearly instructed me I'm not allowed to talk about Q3 earnings.
Oh, come on.
But I will tell you that.
What can you tell us?
What I can tell you is that we in May last year, when we were still investing very heavily at that point of time, I think we booked a negative EBITDA of $150 million in a single month. The same May this year, we booked a small profit, and since then we've seen that we have kept consecutive profitability. So we're very, very comfortable now that we're in good ground. And especially what's interesting about this is the US, right, which is still growing at a massive pace. It's our largest market now by revenue and consumers. And it's also a profitable market for us now. So we're quite excited about what we see. And we've had some amazing new partnerships like Airbnb go live recently, which is really great.
And Sebastian, I want to get you on this question. When we look at generative AI, Sebastian, obviously investors very interested. The race is on globally, US, China. In that global race, Sebastian, where is Europe in your opinion?
Well, there are some interesting AI companies in Europe. I think, for example, DeepL that Klarna uses for translations. Just to give you a fun fact, actually, Klarna used to have customer service agents across the world in all languages. We don't need that anymore. We can do everything in English and translate to over 40 languages thanks to the help of DeepL, which is still the best translation service itself, in our opinion. And you also have some interesting AI companies in France. But in general, to me, we are very happy to partner with OpenAI. We think their technology is amazing. We're obviously looking at other alternatives as well. But the race, to me, is who brings the real consumer product. I mean, ChatGPT to some degree is a consumer product, but there's so much more to do with these technologies to bring really unique and exciting experiences. I mean, look at Character AI, is quite interesting. I mean, their average spending time on that website is like 3.5 hours, people chatting with different AI characters. So it's still going to be so interesting to watch. And obviously, we're very keen to be one of the companies that bring great shopping and banking experiences powered by AI to consumers. And I think that's going to be the interesting area to watch. And we feel that among European companies, we're one very, very good place to be able to do that.
Sebastian, good to catch up with you. I was just trying quickly to look up on one of my AI engines how to say thank you in Swedish, but I couldn't. I don't think I would do it justice. Sebastian Siemiatkowski, thank you so much. Appreciate it.
Thank you. I was like, tack. Cheers. Bye-bye.
Ah, okay. I'll practice. All right, coming up, we're going to go around the horn. Thank you. Coming up, we're going to go around the horn with some of today's top stories, including the cost of returning to the office. That's next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Praz Subramanian. And guys, I want to start on the Hollywood actor strike. It's still ongoing. We did see negotiations resume with studios, but last night those negotiations deteriorated. And I want to focus in on one reason why. And it's something that the SAG-AFTRA really referred to as a viewership bonus. Now, this would be in addition to the streaming residuals. And basically what the actors are fighting for is that when you have a popular show, let's say Stranger Things for Netflix, The Handmaid's Tale for Hulu, those shows that define these platforms, that the actors get a piece of that pie, around 2% of the overall revenue from that show. Now, the studios responded saying that if they did that, it would cost them $800 million per year in addition to everything else that they are paying, and that ultimately they can't afford to do that. And if you think about the streaming landscape right now, every single streaming giant is losing money except for Netflix, which is the only profitable streaming service out there. And so there's this catch-22, and that's one of a few problems that why these talks really deteriorated. But I thought that was an interesting one.
It definitely is, and to me, it just the streamers don't have a lot of money. They have a lot of money. Sorry, I shouldn't say it that way.
Well, their streaming business,
right?
Not.
They're struggling to get to profitability though, and that's a big part of what is going on with the streamers in general. So to get into this, little bit of a nitty-gritty argument with them. I don't know if I love it as far as how the actors are going about it and if they're going to be able to see that money. I just don't know, Pras. It doesn't really quite make sense to me. You're already getting a lot of money up front. You're getting a lot of money to be in the show. Maybe just take the money.
Well, okay, so on the flip side, right, you guys do the management side. On the flip side, actors are saying this is a negotiation. We want to get what we think is fair. They are used to getting actors from big time to small time, used to getting residuals from a lot of big time TV shows that are in reruns. That's going away, right? So they want to say, how do we get that back? You said that there's a streaming residual that they're going to get. Who knows how big that's going to be? It's probably going to be small because it's like hard to quantify. This bonus, I'm not sure what shows qualify for the bonus. They get the extra 2%. We'll see. I mean, it's a negotiation, right? But you mentioned something about the streamers, right? Disney, Hulu, whoever else. They're all part of massive corporations that make billions of dollars. They're of course going to make the stream business look like crap, right? So Netflix can't because they're public and that's all they do. They can't be crap. They have to show profits. So I think there's like a shell game there where the actors are saying, okay, we know what's going on here. We know what's going on here. So I think that's the other side. I'm not saying
to further the manager side,
I'm not saying one side's better than the other.
Isn't part of the argument from the streamers, well, you would be nothing without our streaming service? But like at some point, you need to act in the big shows and be a part of the big shows, right? Like it's not like you're not the only star. So at some point, they're kind of creating you too, and they're paying you for that. So you're already getting paid for it.
The actors, we have singular talents. There's no one who can do what we do. So anyway, let's move on to regular people like you and I. Right? Okay, regular people. We get paid.
Love your average Joes.
We get paid our minimal salaries here. No, I'm just kidding. I'm kidding. But anyway, so if you thought that return to work was bad enough because you were already sort of happy working at home and comfortable and being as productive as you thought, a new study by a company called, let me get this straight here, video lab conference company Owl Labs shows that actually it costs you $51 to return to work, right? Because of the costs entailed. So they break it down as this: $16 for lunch, $14 for commuting costs, $13 for your breakfast and coffee, and maybe $8 for parking there, $51 a day. So that's what you wouldn't, they're saying that's what you pay on top of what you wouldn't if you stayed at home. So this makes it kind of even doubly worse. Like, is it worth it for you as an individual to pay $51 a day on average or so just to come into work when you can work from home?
Yeah, and we did a fun little experiment to calculate how much we all pay when we're commuting to work. And for me, I did two different scenarios because there's some days where I wake up and I have early things and I just want to take an Uber. So I take the Uber. Uber costs me $20. Coffee, I usually stop at Starbucks. I don't do this every day. This is like my bad days. Coffee, average $7. You know, you're getting a cappuccino, anything with a little pumpkin spice.
$7 coffee
It's gonna
hurts.
be, now look.
So much on the right side of that screen just hurts.
I don't agree with it, but I do pay it. So the coffee is $7. Lunch, always give or take a couple bucks, around 20. I always walk home, so that costs me nothing. But wow, even my Subway days, I'm spending $30. I mean, it's true. This is a lot of money. And Pras, you and I were here before the pandemic. We used to get free lunch. We used to get all these perks. We don't anymore, and that now adds into your cost of coming to work.
Do you want me to show you how to save money? Okay, let's bring up my budget. Let's bring up my budget.
Make me feel bad.
My budget is a bodega sandwich. It is $9.95.
You and a sandwich.
And that is basically, and I don't even get that every day. I try to bring lunch probably about 3 times a week.
You live close to work, so you walk.
So I walk to work.
Back.
Yeah. So I walk to work, so there's no expense there. There's coffee in the office. Just drink the coffee in the office. You don't need to get a $7 latte.
I don't, like I said, these are my
coffee.
splurge days. I don't do it every day, but yeah.
Let's take a look at mine, real quick. Mine. So basically, I think I'm hitting around 30. Sorry, Subway $5. You know, when you combine both, going back and forth. Lunch 20. Okay, look, lunch 20. I'm kind of salty about that. Whatever I go, Cava, wherever, $20 is too much. Coffee $5, $30. So a lot going on there. But I think we have an award for the bougiest reporter here at Yahoo Finance. Can we take a look at that, please? There we go.
Okay.
And there we go. Interesting spelling of bougie, but we'll take it, right?
Bad and bougie. You know what? I'm going to work on this. I think I'm going to try to challenge myself not to spend anything in a day. I've said this to myself multiple times.
What are you going to eat?
I'm going to have to cook for myself, make food.
But that still counts as money. And that's part of the thing with this return to office thing is you're paying money even if you're at home. Yes, it can be cheaper, but also that study included buying breakfast out. Don't buy breakfast out if you're commuting in the office. Make breakfast at your house before you leave.
Some people don't have time.
And let's not forget the opportunity cost of our time to commute.
There you go.
That's a big factor. I know you don't believe in it, but time is money.
Pross is talking about lunch being too expensive, and one of those prices that's going up is hot dogs. Hot dogs in September. This is from the BLS CPI report out this morning. Hot dogs saw the biggest monthly increase we have seen since 2002 between August and September. That's up 6.8%. So hot dog prices, guys, soaring. And hot dogs are supposed to be one of the cheaper items. So that's really what sort of stands out to me in the inflation report. So we went out and tested it ourselves.
Yeah, you know I couldn't do this segment without having a nice hot dog in my hand.
What did the hot dogs cost?
So I got four dogs. They cost me $5 each from Shake Shack.
That's pretty expensive for a hot dog.
And, you know, pork prices, they went up by 1.6% over the past month in the CPI report. Other food items like eggs, for example, that has been on a steady decline. That went up 0.9%. So we're seeing food once again rise. And, you know, we're playoff baseball season.
The real question
is
it worth $5? And we'll bite in and find out.
My mustard is a Chicagoan, but.
No, I've never had a Shake Shack hot dog.
I would pay $5 for this. That's pretty good. That's a good dog. But
I love a good dog. Now we're chewing.
The thing that stands out to me about this, though, and when you think about the inflation report in general, and we talk a lot about what the inflation report means for the Fed, we take out all the things that we actually live for.
Yeah.
You take out food, you take out shelter, you take out energy. That's the majority of our costs. And then we're looking at inflation and saying, okay, inflation's coming down. It's generally good. That was something that I was just thinking about today when we were taking a look at the report is I care more about what I pay for this.
Oh, yeah.
This is what I care about. You know, I care about this.
Prices,
I care about gas in my apartment. I care about those things.
And look, gas moderated a bit compared to what we saw in August, but it's still high and it's still going up at the end of the day. And these, you know, your average consumer that can't even get a cheap hot dog, that's a problem.
But from our Wall Street world, right, they want to see what are the non-volatile prices of stuff moving. Are they moving up higher too, right? That's the whole complaint. But you're like, everyone's like, my gas, my shelter, my hot dogs
and shelter
are going crazy.
Shelter is just continuing to go higher and higher, and there seems to be no reprieve in that.
And Jerome Powell's talked about that in the past, though, talking about how he understands that people do care about headline inflation. The fact that that number has been at 3.7% for 3 straight months, people care about how much they're paying for these.
People care about their hot dogs.
They care about the hot dogs.
And
We all here. Cheers.
And one real quick thing. Jerome Powell did say you can't have 2 dinners, I believe, right? You can't eat dinner twice in terms of an inflation argument. You can't have 2 hot dogs.
You know what, Praz? Words to live by. We're going to finish these hot dogs. We have more Yahoo Finance on the other side of the break. Stay tuned.
These are
Women-owned businesses represent more than 41% of the nation's total. That's according to the U.S. Census Bureau. However, the impact of women-owned businesses diverges significantly across the U.S. Some states show these enterprises flourish. Other states still have room for improvement. Here with more on key drivers to foster growth for women-owned businesses, we got Wells Fargo Senior Lead Business Growth Strategy Consultant Val Jones. Val, you guys just came out with a list of the states that are best and worst for women-owned businesses. And I see at the top of the list here, we've got New York, North Carolina, Georgia, whereas at the bottom, Wyoming, Nebraska, Alaska. What differentiates them? What makes a state good for a woman in business and what makes it not good?
Yeah, great. Well, thanks so much for having me here. Happy to talk about our findings from the report. I would say the common denominator for the top states is, first of all, a economically sound foundation. These are states where there's typically a lot of growth, there's a lot of support for businesses, and we see that as a foundation. But in terms of women-owned business, what we do see as a difference maker are special programs, grants, and incentives for businesses to support women-owned businesses in these areas. And we found that especially through the COVID pandemic. And as we are in this phase of COVID pandemic, that was really the difference maker. And you can see right here, training, counseling, networking, we find women really could benefit from expanding their network. Financial assistance, not just in terms of a formalized education system, but having one-on-one coaching, support, and mentorship. And then just specialized programs identifying needs that women-owned business have in particular.
And Val, what role does education play here for young women?
It plays a big role. So in those top states, we do find that there are special educational programs. And to your point, for young women, how do we educate high school girls? How do we educate college-age women as they think about launching their adult lives and entrepreneurship as being a possible option for them? It makes a big difference.
And then, of course, there's sort of the less tangible stuff like culture, right? Which I guess all of these other things go into changing and improving the culture so that women feel more empowered here. Some of that also has to do with sort of mentorship and networking. How does a state sort of promote that type of opportunity?
Yeah, absolutely. So what we see in some states and some municipalities is that they have designed special programs and they partner with organizations such as Association of Women's Business Centers, SCORE, and other organizations to develop and enable programs that are designed for women specifically.
And Val, what about the role of child care, elder care? What's the role of the state for those kind of programs, in your opinion?
Yeah, so that's a great question. I don't know if a lot of people think about childcare and how it impacts women-owned business, but as we all know, caregiving, whether it's for children or for others in our family, often fall on women. And so when they're in that situation and trying to run a business, it becomes really difficult to manage all your responsibilities. So having affordable childcare options is a huge difference maker. So some states provide free pre-K, for example, and other incentives to create more affordable healthcare options. And that is a difference maker that we see in these top states.
Hey, Val, during the pandemic, we saw an uptick in women-owned businesses, right? A lot of women got creative while they were at home. They developed side hustles. The work-from-home options gave a lot more flexibility to women in particular. Now that, we're a few years on, where do we stand in terms of the number of businesses being created and sustained by women?
Yeah, great question. Those were certainly driving factors for women, but we also saw corporate employees thinking about side hustles, for example. So there was a lot of creation and growth in this space. So from 2019 to 2023, we saw 1.7 million new firms. And we also saw growth in revenue and job formation as well. So this was an interesting finding of the report. We did an analysis of employer versus non-employer. And you think about the non-employers, the solopreneurs, the side hustles. We did see growth in that area, but we also saw more employer firms. So women-owned businesses who maybe didn't have employees before were now hiring employees. And this was an unexpected surprise. So we haven't really seen this in economic downturns in the past, but COVID was really a difference maker. What was the difference? It was all of the support that we provided from a government standpoint, from philanthropic giving, corporations. We all put our arms together and said we need to support small businesses in a different way. And this really created much better outcomes for women during the recession, for example.
Val Jones from Wells Fargo. Thank you for stopping by today, Val.
Thanks for having me.
Carolyn Ellison wrapping up her testimony in the Sam Bankman-Fried trial. Alexis Keenan joins us now from outside the courthouse. Alexis.
Yeah, things just wrapping up here for today. And it was a big conclusion of the testimony and cross-examination of Caroline Ellison, who was Alameda Research's CEO in its final approximately year of the company's existence. Now, I'm going to do for you what I think the jurors are going to have to do in their minds to try to piece together this very complicated story. And that is to figure out what punches did the defense attorneys on behalf of Bankman-Fried land today, if any. So far, it's been a bit of an uphill climb to try to put all these pieces together and tell this complicated financial story. For one, Ellison said that she met with prosecutors about 20 times before her testimony. She said that she prepared documents all the way back to 2021 and through 2022 that showed her own impressions. Now, at the top of one of these lists was her number one bullet point, and it was things that Bankman-Fried was concerned about, and that is number one, hedging. Now, if you remember back to opening statements, that was a big part of Bankman-Fried's story, is that he had instructed Caroline Ellison to put on hedges in order to not get Alameda into a complicated financial situation, and FTX as well, to not be able to return those customer deposits. And he said that she did not do that. Now, she said that was important, that she did decide at times to not go ahead and hedge months, if not a year before things all came crashing down for FTX and Alameda. She also said that she was a bad manager in some of her own impressions, her own notes. And she said also that by the time she was being questioned by prosecutors, that she thought what she did at her time was wrong. She also admitted that she posted misleading tweets in the final days of FTX as it was crashing down. And she also admitted that while all of this was happening, that she was still accepting a $200,000 salary along with a $20 million bonus for her first year as CEO. And then on top of that came a $3 million compensation for that half of last year. Of course, she didn't see the end of days. The companies did not complete a full year in 2022. She also admitted that the company, Alameda, had to function as a market maker. That's another point that Bankman-Fried is trying to make, to say that it needed to be able to draw into negative balances in order to function for FTX and buy various cryptocurrencies for its customers. But guys, this is a lot for the jury to try to put together. It's hard enough as a journalist to try to link these pieces. The dates are jumping all over the place. And in the end, we'll see what Bankman-Fried has in terms of him putting on a case. But right now, the prosecution is still ongoing with its additional witnesses and expected to go another 2 weeks with its case.
It has been fascinating. Alexis, thank you so much for the latest on this. Appreciate it. Coming up, it's closing time here on Yahoo Finance. We're going to recap some of the top stories of the day, get you set up for everything you need to know tomorrow. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Taylor Swift making music history today, announcing she's going back on tour after a 5-year break.
Pre-sales for her upcoming tour kicked off yesterday, but a surge in demand caused Ticketmaster's website to freeze or even crash altogether.
There's so much fanfare around the summer that has been Taylor Swift.
The Philadelphia Federal Reserve mentioned the impact that her tour had on the economy. Jersey sales for Travis Kelce up 400%. His podcast hitting #1 on the Apple charts, all because of Taylor. Taylor Swift.
Taylor Swift.
Taylor Swift.
Taylor Swift.
Taylor Swift is breaking the internet again.
Almost 1 year ago, singer-songwriter Taylor Swift began a journey that would change the American economy as we know it, starting with ticket sales for the Eras Tour. Over 3.5 million people signed up for Ticketmaster's verified fan presale, but only 2.4 million tickets were ultimately sold. The unprecedented demand created a frenzy that resulted in a congressional hearing against the ticketing company, all while solidifying Swift's status as the world's biggest pop star. The tour kicked off in March of 2023 and has since blown up headlines and even landed in Philly's Fed Report. Analysts expect the tour to pass the $1 billion mark during its international leg in March of 2024. That would be Elton John's nearly $940 million record for his farewell tour, which concluded in July. Swift's Eras Tour is also expected to generate as much as $5 billion in consumer spending in the U.S. People are dropping money on plane and hotel tickets, fun outfits and merch, $75 hoodies, $55 long-sleeve shirts, and we didn't even talk about ticket prices, with resale tickets selling between $500 to $7,000 a pop, and in some cases, even higher. And that economic impact has only grown beyond the tour, with Swift now rumored to be dating Chiefs tight end Travis Kelce. Ticketing platform StubHub reported a 175% increase in ticket sales after she attended one of his games. And according to fan merchandise company Fanatics, Kelce's jersey sales have increased by 400% since that first Swift appearance. And now her team is taking it one step further by releasing a big screen adaptation of her popular Eras Tour. Pre-sales alone have already skyrocketed past the remarkable $100 million benchmark, with more room to run as fans flock to theaters. Bottom line, the Taylor Swift economy isn't going out of style anytime soon.
It is closing time here on Yahoo Finance. Here's a look at some of the top stories of the day. Ford providing an update on its UAW negotiations after the union announced a walkout at its Kentucky truck plant. The automaker says it is, quote, at the limit on what it can offer to workers in terms of higher wages and benefits. The company also warning that the strike in Kentucky, which is Ford's most profitable plant, would harm workers and slash profits. Ford shares were down 2% on the day. Another Fed official speaking out, saying the rise in bond yields could reduce the need for another rate hike in the near term. Boston Fed President Susan Collins commenting that today's CPI report shows calming inflation is going to take time. And Dollar General shares spiking after hours. The company announcing its former CEO, Todd Vassos, is coming out of retirement to come back and lead the retailer, replacing Jeff Owen. Owen had been CEO for less than a year.
And here is what to watch tomorrow. The biggest news will be bank earnings. The read will give us insight, not just on the state of the financial industry, but also how corporate America is dealing with higher interest rates. And we'll be getting a further Fed speak from Philadelphia's Patrick Harker. We'll see if they join the ranks of other members this week who have indicated rates may be at their peak. Preliminary consumer sentiment is out tomorrow morning for the month of October. This coming after sentiment saw a decline in September. And last, around 10 a.m., the leader of the UAW will broadcast a Facebook Live to announce the next steps in their stand-up strike action against automakers Ford, GM, and Stellantis. Today, in their biggest escalation to date, union workers did not turn up to Ford's biggest truck plant in Kentucky, with more than 8,000 workers joining the action.
Well, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow. We'll be talking about many of those things that Josh was just mentioning. And join us at 3 p.m. tomorrow.